Okay, welcome back, everybody, to another episode of Who Charted, the most exciting 6 charts in markets. With me, as always, is Manish Kata. He's going to set them up, and I'm going to knock them down. What do you got today, Manish?
The stock market is not the economy. The stock market is not the economy. That's the title of this show. Let's get going. The 10-year yield has faded from resistance. Consensus for interest rates is to move higher. Bullish or bearish?
I think that this is bullish for the market, which is what we care about, but the market is not the economy. I think that this is probably bearish from an economic standpoint. Consensus view is that rates are going to go higher. Now, we're probably going to get another rate hike out of the Fed here in July. Maybe that's the last 25. Maybe there's another 25 behind it. But the 10-year yield is trapped in this range, and it could not break out, and now it is beginning to turn down. So the reason that I think that this is bullish for the market is because, generally speaking, lower rates should be, all else being equal, a tailwind for technology stocks. Technology stocks, the largest part of the S&P 500. So if this is an added tailwind to tech, that's beneficial to the market. However, if you look at the bottom of this chart, that is the 10-2 curve, and it is beginning to move higher. We've talked about this a number of times. It is the uninversion, a word we made up, I think, of the yield curve that is a better marker of an imminent recession. So not there yet, still inverted by a decent amount from a basis point perspective. But as that yield curve begins to move towards the zero line, that to me is a better signal of an imminent recession. So we're going to say that this is bullish on the market, bearish on the economy, but the economy is not the market.
It's hard to believe that the fastest rate increase on record is just going to poof, go away.
I think that kind of begs the question, like, did we even need zero rates? Like, was zero rates might turn out to have been the policy error? We'll see.
Time will tell. God bless Marty Zweig.
We love Marty.
Next up, we have the dollar that has been declining recently. At least recently, there's a inverse relationship between the dollar and stock market. Bullish or bearish?
This is bullish for equities in general. There is an inverse relationship between the dollar and risk assets, but let's stick to the stock market right now. So everybody in the FinTwit universe, everybody who doesn't really manage money, was getting all excited about this breakdown in the dollar and how it's going to be a tailwind for equities. If you were actually fine, listen, I believe that, right? This is bullish for equities, but this is nothing new. This is just a continuation of a signal that, by my work, has been in place since November, right? It was, if you were going to use the dollar index as a signal to trade equities, just some of the work that I've done over the past couple of weeks, that signal was in November. This is just a continuation of that signal. So everybody's getting super excited about the dollar breaking down, but it's nothing new. It's just a trend that's still in place. So below the moving averages, this just looks like an absolute train wreck from a chart perspective, and that is bullish for equities to the extent that it continues. However, continues is the operative word. This is not new. If you're just catching on to this now, wake up.
Always remember that a supporting chart doesn't necessarily mean it's a trading system. It's just a chart.
Just a chart.
Technology is the largest sector in the S&P 500, roughly at 29%. It made a new high. Your favorite leading indicator, semis, also made an all-time new high. Bullish or bearish?
It's hard to argue that all-time highs are anything but bullish, right? And technology, as we said, being the biggest industry group or sector within the S&P 500, right? These are the generals, and if the generals are leading, that's going to provide a tailwind for the market. Maybe it pulls the market higher. It's arguably going to lead people to say that only 7 stocks are leading to all the performance, which is patently false. We've shown you breadth charts in our written work and on this show, but you have tech leadership right at the bottom of the chart relative to the S&P 500 outperforming. You have tech trading at all-time highs. It's hard to argue that that's anything but bullish, and to the extent that tech continues to work and continues to lead, if you're a passive indexer, stick to your passive index that has a lot of tech exposure, I guess.
Don't complicate it. Momentum begets momentum. End of story.
The ball rolling down the hill is hard to stop.
Next up, by all accounts, we're pretty overbought on the market, at least currently. The 200-day Z-score is over 2%. Bullish or bearish?
All right, so less people start watching this show and the first three charts, they start thinking that, Dan is turning into an outright bull. Let's kind of rein things in a little bit. Doomsday Dan has to make an appearance, although this is kind of a weak version of Doomsday Dan. You and I have been talking about this. Some of the indicators that we use and that we pay attention to have become extended to the upside. A simple way to see that from a longer term trend perspective is to just take the 200-day Z-score. It's over 2, meaning the S&P 500 is more than 2 standard deviations above the 200-day moving average. Now, if we were newsletter writers, if we were reporters, we'd highlight that the last time we were this extended was right before COVID. So, whatever. Take that with a grain of salt. Extended doesn't mean you hit the sell button. You need some sort of confirmation like anything else. But look, we've had a nice move off these October lows. We've kind of rallied here in the first half of the year, and we're extended here in the near term. And this is one indicator that shows that. We have others that we use that paint the same message. I think we were talking about it just this morning about one of them. So fine, a little extended here in the near term, right? If you're a short-term trader and maybe you don't chase here, but you're above a rising 200-day moving average, bigger picture, the trend is still okay. Where you're probably not going to fall out of bed like we did in February and March of 2020. But, if we did, there's other indicators that would catch that. Right now, just a little bit extended. So I had to kind of, work in a little bit of a bearish chart here. Otherwise, my reputation will take a hit.
Another supportive chart, not an indicator. You can stay overbought for quite a long period of time. And so it's just a supportive chart. Good luck trying to trade that thing.
Yeah, it's definitely not a timing tool. And if you go back and look at the chart, you'll actually see that we were bumping up against that 2 standard deviation mark through the majority of 2021, right? So if you tried to take your shot and sell, or even put them out on the short side, you would have gotten run over. It's just a data point, something to pay attention to, and confirm some of the things that we're seeing internally.
Next up, we have seasonality. The pre-presidential year is one of the strongest years on record. In addition, the first half of the year is really what generates all the gains. Also, the sell in May go away. We are now approaching the weakest part of that as well. Perfect segue from the overbought Z-score. Bullish or bearish?
So it's interesting, right? So you're overbought in the near term, and we are just about to enter the bad part of sell in May and go away, right? August tends to be a flat month, kind of do nothing. Everybody's on vacation. Then everybody comes back for September and decides to sell the market, right? Generally speaking, this is monthly average returns going back to 1950 for the S&P 500. So usually sell in May and go away. Obviously, it does make sense, but July is a strong month, and so far we are living up to that. We're actually coming into today outperforming the average Julys. But if we kind of want to look at the market and say we're a little overbought here, and say August is kind of a punk month and September tends to be a weak month. My near-term views on things, you want to take these things into consideration. If you're thinking about chasing now, if you just woke up and decided that this isn't a bear market rally and that it's actually something to it, maybe now not the perfect time. Trend is obviously still up, but these kind of 2 negative data points that I have here give me pause if I was looking to, dive into the market, right? If you've been sitting in cash since October, God help you, and you're going to decide now's the time to get in, well, we're extended and we're coming into the worst part of sell in May and go away. So some data points out there for you to consider as part of your process.
Seasonality is the best way to the passive crowd.
I love the passive crowd.
Next up, we have what is a classic definition of the stock market is not the economy. The stock market is not the economy. ISM and the S&P 500, bullish or bearish?
I don't know what you make of that. Let's call it neutral because I'm going to punt on it. It's ISM under 50 is considered contractionary, but the stock market is not the economy. Look, if you believe that the stock market is a discounting mechanism, the stock market topped at the end of 2021 for the NASDAQ, first 2-3 trading days of 2022 for the S&P 500. And if you look at this chart, you see that is kind of the beginning of a precipitous downtrend for the ISM Purchasing Managers Index. So if the stock market's a discounting mechanism, you could argue that what we saw in 2022 for the market, at least up until October of 2022, discounted these current mid 40s readings on the ISM Purchasing Managers Index. So, I'd argue that this is, I'm going to say this is bullish for the stock market, not so much because you should run out and buy it, but because the stock market appears to be doing its job. The stock market, acting as a discounting mechanism, discounted these mid 40 ISM prints. And, maybe they're starting to set their sights on, something different. The Fed's probably tail end of a rate raising cycle, and the market is starting to discount that. So kudos to the market for doing its job and staying focused on what it's supposed to do and not caring about what's happening in the economy. The stock market is not the economy. And I'll leave you with this to really burn some people. The stock is not the company. They're two different things.
I think it's actually quite hilarious, the people who try to justify market moves with nonsensical economic data points like PMI and jobs reports and blah, 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 blah. They've tried over and over and over again to do that. No one with a long-standing track record is still in business that has actually tied the two together. But it's good for tweets, I guess.
Good for tweets, good for clicks. I guess if you're selling a subscription and you want to sound like a doomsdayer, take a look at the
clicks
PMI
get
under
the
50.
chicks.
My God.
All right, that'll do it for Who Charted. Thank you for joining us. The bull market is on, baby. Doomsday Dan is going to go back in his closet and hide until the next episode. Please like, subscribe, leave comments, do what you do. Have a good one.
Sell a man, go away so Doomsday Dan can come out.